Hello and welcome to The Year Ahead, a podcast series where we explore the big themes and events moving markets and shaping the economy in 2024. Today, we're going to take a closer look at the macro backdrop in 2024, what that means for our corporate clients as they begin to think about their hedging, funding, and liquidity needs into next year. I'm Imogen Bachra, Head of Non-Dollar Rate Strategy, and I'm very pleased to be joined today by our experts, Ross Walker, Paul Robson, and Carla Floyd. Okay, Ross, I'm going to start with you because I think that's the best place to start to kind of set the scene for this discussion. Perhaps you can just recap our kind of key views on the economy, on inflation, and what we're thinking about rates into the year ahead.
Yeah, certainly. The UK economy has broadly flatlined over the last 12 to 18 months, and we expect something similar over the next year or so. The monetary policy tightening that the Bank of England has been implementing since the end of 2021 will increasingly feed through into debt servicing costs, both for households and corporates, and that will further squeeze demand. That weak growth I mentioned is now beginning to show up in rising unemployment. We think, unfortunately, that has further to run. That will constrain demand, but that will help to bring inflation down. And the inflation picture certainly looks a little bit more optimistic, I think, than 6 or 12 months ago. Those big energy-driven and to some extent food price inflation-driven falls are still working their way through the data. Core inflation is a little bit stickier, but as demand pressures ease over the course of next year, we think core inflation will start to come down a bit more quickly. And essentially by the end of 2024, certainly early 2025, we think headline CPI inflation will be at or pretty close to its 2% target. And that trajectory for inflation through next year, through 2024, opens up, I think, the possibility of Bank of England rate cuts. Maybe not in the early part of the year. Other central banks, the US Fed, the European Central Bank, seem more likely to move first in cutting cycles. But we look for the Bank of England to be easing monetary policy in the second half of 2024, perhaps the first cut coming in August, and bank rate coming down from its current 5.25% level, which we think is the peak, to more neutral levels over time, somewhere between 3 and 4%.
Just wanted to pick up on what you said on inflation there. You seem, I guess, optimistic that inflation does return to this 2% target. But how do you assess the risks that actually, not necessarily getting back to a lower level of inflation, but really getting back to that 2% is going to be hard, and actually some kind of level around 3 or 4% is perhaps considered the kind of new normal when it comes to the inflation outlook in the UK?
Well, certainly the experience over the past year or so cautions against complacency and how quickly inflation can return to target. I think the difference is now versus a year ago. Why are we more confident today that inflation will come back to 2%? Well, as I say, I think we see clearer evidence of slowing in economic activity and also, crucially, those weaker labour market trends. And I think that will feed through to the wage setting process. Also, headline inflation falling back very sharply. This time last year, it was running at double-digit rates. That lowers that basic reference point for starting point for wage negotiations. So I think the economic fundamentals give us more confidence that inflation will come back down. Are we at risk of a more persistent overshoot? I'm skeptical about this, or at least I'm skeptical that either the Bank of England would make the same policy error repeatedly that resulted in a more persistent overshoot in inflation. And I'm certainly doubtful that they would tacitly just allow inflation to run some way above its target. So I think we're relatively confident that the bank is serious about hitting its inflation target. I think the more reasonable concern is not will they deliberately try to miss the target, but are we entering a world where underlying inflation pressures, domestically generated inflation pressures, are perhaps a bit stronger than in previous cycles? And that in turn will force central banks to lean more heavily against those domestic inflation pressures. Because what we don't have in this coming cycle, we think, relative to certainly the great moderation, the decade up to the financial crisis, but even the period after the global financial crisis, we don't have the same degree of global price disinflation. And so just arithmetically, for the UK, imported inflation is about 30% of the basket. So if you don't have that falling price pressure from the rest of the world, cheaper imported goods, commodities, you will have to bear down a little bit more heavily on domestic inflation. So I think the job for central banks in controlling that inflation is going to get a bit tougher over the next cycle. But I think the idea that inflation might settle or average at 3 or 4% feels too pessimistic.
Going back to those economic fundamentals, then you talked earlier about the kind of weaker growth outlook that's already feels, like it's taking place in the UK. One of the drivers, I suppose, of your view on growth in the UK comes down to how you see business investment evolving over the next couple of years. What sort of capex trends do you think we're likely to see among corporates, and how is that feeding into your UK growth view?
Yeah, indeed. I think the persistently weak business investment trends, essentially since the middle of the last decade, around the time of the Brexit referendum, are probably, for me, the biggest medium-term worry around the UK economy, because ultimately you need that investment growth to drive productivity, to raise living standards. As I say, business investment essentially is unchanged in level terms since 2016. Had the previous trend continued, our capital stock would be around 15% higher. So it's definitely something which in the near term feels like it will hold back economic growth and productivity and ultimately living standards. So this is not an abstract economist concern. This is absolutely fundamental to the UK outlook. Now, admittedly, we did see in the first half of 2023 a pickup in capex, but that seemed to be driven by peculiar one-off factors. So the ending of the investment super deduction tax allowance at the end of the first quarter meant there was a bit of a rush to get some of that capex over the line before that cut off. And in the second quarter of the year, there was some huge aircraft sector activity, aircraft orders, which would boost the capex numbers. What we've just seen in the third quarter numbers is that the level of business investment fell back very sharply, a drop of over 4%. So I think that what that's telling us is that we've got through a couple of what looked like quite favorable outturns, but were actually one-off distortions, and we've reverted back to this lower trend. Survey data on business investment still looks a little bit cautious, a bit hesitant, which isn't a surprise because we have a sort of cyclical downturn probably coming ahead of us, at least a further flatlining in growth. Funding costs are higher, and there are some post-Brexit structural challenges for the UK economy, essentially, which probably weren't really able to be fully addressed against the backdrop of the pandemic and the Russian invasion of Ukraine, the energy shock around that. So for me, the capex outlook probably is a little bit tepid in 2024, but hopefully this can regain some traction the following year.
Here's hoping. Okay, thank you, Ross. Paul, probably a good time to bring you in then and think about, everything that Ross has been through in terms of how we see the economy and inflation evolving over the next year and what you think that means for FX. Before we go into what we think this means for sterling specifically, perhaps you can just give us a bit of an overview of what you think will be the primary focus for currencies as we head into 2024.
Yeah, I think for global currency markets, they can be framed within this transition from a global tightening cycle to an easing cycle via a plateau in rates. Central banks have spent the last sort of year, 18 months facing a particularly nasty inflation shock from energy and food prices and supply constraints. They've tightened monetary policy, but at some point they'll call victory on that and start easing. This is fundamentally important for currencies because the short-term driver of currencies is interest rate differentials, what the policy rate is today, where it's going. And for the major economies, we think you're going to get quite a lot of divergence and differentiation because not all economies are born equal. They will face, central banks will face different outlooks for inflation. Policy rates will move at different paces, and given the correlation between FX and yield, that's going to be important. So the sequencing of any easing of monetary policy across the major economies is going to be important, we think. The other factor to think about for global currencies is relative growth between the major economies. At what point do we get to peak optimism around the US economy? When do we get to the point of peak pessimism for the Euro area, European economies, and Asia? That could be fundamentally important, especially for the dollar, because the dollar is driven by two things. One is relative yields, but the other driver is how the US economy is doing relative to the rest of the world. And at the moment, or it has for the last 18 months, had it all its own way, really. Whether that changes in 2024 is going to be the key question for global currency markets, because the dollar will lead that.
And bringing it back then to sterling specifically, how do you see your outlook for the pound fitting within that global currency view? And here specifically, I'm thinking about sterling versus the dollar and sterling versus the euro.
Yeah, I think the sterling outlook fits quite neatly within that framework, and particularly the sequencing of easing from the central bank and from the Bank of England, something that Ross mentioned in his opening comments. He noted that the Bank of England might be easing policy sort of later than other central banks. And the key here is that those two exchange rates that you mentioned, sterling dollar and sterling euro, have continued to track interest rates relatively tightly over the last 18 months. At times, people have wondered about interest rate expectations relative to inflation expectations. They've worried about, and including myself, worried about the growth outlook. But the dominant driver of sterling seems to have been interest rate differentials, and that's going to be the focus, we think, as we transition from that global tightening cycle to a global easing cycle. The other key point for sterling, I think, is this idea that there doesn't seem to be an excessive risk premium in the currency that needs to be unwound over the quarters to come. So what's this risk premium? Well, the way I describe it is, if you're going to buy a new car, you have options. You can either go to a franchise dealer, you can go to a specialized dealer, or you could buy it off the internet. And each one of those prices are going to vary because they each come with a different level of risk, a risk premium. And it's exactly the same for currencies. And over the last 4 or 5 years, sterling has always come into the year ahead period with really quite a large risk premium. This in the past has been about, say, COVID. The UK was set to be impacted more than average from COVID. That didn't quite work out. Sterling recovered. Last year, you had the European energy shock to the economy, and sterling did relatively well as energy prices came down. And before that, you had the issues of a potential no-deal Brexit. But as we go into 2024, we don't seem to have any of those specific risks around the UK that needs to be unwound. And that leaves the outlook for sterling very much on interest rate expectations. The third point on the sterling outlook, and this is the potential Achilles heel for sterling, and that is relative growth. Because as Ross noted in his opening comments, we think that the growth outlook in the UK is going to be really quite poor relative to other major economies. And given that we run this current account deficit, that's potentially important. But when we put all that together, we think that sterling dollar might remain relatively constant in the beginning of the year, but start to strengthen in the second half of the year. And for sterling euro might have some upside until the second half of the year once it starts declining.
And so, Paul, last question for you is, what would you say is the key message for anyone that's thinking about or needs to hedge their currency exposure in 2024?
Well, I think the key message is really around sterling dollar and this idea that once the US Fed starts to cut monetary policy from the policy rate, we expect it to happen relatively quickly. And this idea that sterling dollar could end the year, relatively high from the levels that it started the year. So for those out there that have a requirement to buy sterling, then layer in exposure at the beginning of the year seems to be appropriate. But for those that want to sell sterling or have a requirement to sell sterling, just waiting for the second half of the year to achieve better levels. And it's the opposite for those that have exposure to sterling euro. We think that sterling euro goes higher at the beginning of the year. So people that need to sell sterling could probably layer in some coverage. But those that need to be buying sterling over the year ahead, probably holding off until the second half of the year. Those are the key messages. There will be other volatility, for example, in sterling yen, we think. But the key message for corporates is watching this dollar exposure through 2024.
Great. Thank you, Paul. Okay, Carla, I'm keen to bring you in here and think about everything that we've heard from Ross and Paul and what that might mean for our corporate clients going forward. So starting with the kind of rates and inflation backdrop that we've discussed, do you think that we're going to see big shifts in the attractiveness of different pockets of liquidity that corporates have available to them in 2024?
Yeah, thanks, Imogen. I mean, look, really, this has been the case and the story for the past few years since COVID, where we've seen those kind of ebbs and flows, both from a technical perspective, where it may be undersupply or saturation of the market, or and then the impact that has on investor cash balances, but also the credit environment and how banks are responding to that. So, if I think about some of the key pools of liquidity as we talk about it for corporates, I mean, firstly, starting in the capital markets, we've seen that actually corporate supply is up year on year across euro and sterling balances. It's around 17% up. But that's really been these sort of pockets of attractive liquidity. We've had sort of droughts where there's been very limited issuance, and then these periods where really strong levels, on a comparative basis, have allowed attractive windows for corporates to issue into. But conversely, on the US private placement market, there we've actually seen, a real sense of undersupply, with issuance down 12% in 2023 today. And sort of interestingly, within that, UK issuances are kind of particularly quiet and down. And there's two factors at play there. One of them is the higher level of rates and sort of the sort of discomfort with gilt yields where they are. But the other one is that relative value of different markets, where we've seen issuers have access to both public and private, and looking at that opportunity, and the public markets have offered more competitive levels. So, and then if I take it back into the bank market and bank liquidity, there's sort of the market's down around 20%. A lot of that is driven by limited M&A, but also that where people haven't needed to fund, they haven't. So I guess bringing that into conclusion, I don't think this is a new phenomenon. I think it's something that we've got quite used to over the past couple of years. But with some of that uncertainty around rate outlook, currencies, inflation, add in low growth, geopolitical tensions, regulatory changes, the story continues to be have access to different pools of liquidity. Funding by diversification wins the day here, and sort of be ready to respond and be nimble to market changes when they present themselves.
You touched briefly on kind of bank appetite there, and also regulatory changes. And I just wanted to pick up a bit on that in more detail. How do you think that bank appetite for lending will be affected kind of by new and potentially more stringent capital rules coming down the line?
Yeah, look, it's a really interesting dynamic. So, I guess the first thing to say is Basel IV is not yet, or, the evolution of Basel III is not yet sort of locked down, and how it plays out and manifests itself across the different regions will be interesting to see. But it's sort of currently forecast to come in 2025, with a kind of phased implementation approach through kind of the next 3 to 5 years. But you know, as it's currently presented, if what is fully implemented, we're expecting for the largest US banks, we're expecting them to hold approximately 24% more capital than they do today. So invariably, that is going to have an impact. And what we're seeing is that sort of starting to play through now, and banks having to, particularly as we plan ahead to 2024, have to think about what is that, what does the new world look like under that capital regime. So what does it mean? I mean, there's kind of the key thing is looking at relationship returns, and I know that's sort of a sort of somewhat obvious thing to say, but we're definitely seeing increased focus around the full client relationship, so access to ancillary business, and also banks being sort of comfortable to take a step back, whether that be exit relationships or down tier their lending positions where those returns aren't satisfactory. You know, so that's the capital picture. Then you add in the credit and the sort of macro challenges that we've sort of touched upon and we're facing into. We're definitely seeing some of the dynamic around flight to quality, differences of bank strategy, of the sector appetite that people are thinking about. And also ESG comes in here at the moment. ESG considerations are becoming much more mainstream. It's less of a product. It's more of a, how does that impact lending decisions from a credit, from a capital, and from a strategic perspective. So, you know, it's definitely acute in terms of how banks are thinking. Deals are taking longer to complete, but the liquidity remains. You know, as I said, the banks have stepped up when needed, but it's just about staying close to your banks and for banks staying close to your clients.
Yeah, that makes sense. In summary then, given everything that we've been through on this pod, you know, whether it be through a timing perspective or thinking about the structure or otherwise, how do you think that organizations should be thinking about funding themselves and about risk management in 2024?
Yeah, look, I think it's quite a simple message, really. It's be nimble, be proactive, and stay close to your banks. So on the funding side, if I take that first, you know, markets will continue to be volatile. 2024 is going to be quite an interesting year, a bit of a pinch point, both in terms of bank capital, as we referenced, and also, you know, the macro headwinds, which there's no sort of obvious end in sight. It's sort of going to be an interesting year from that perspective. So, you know, having that access to different pools of liquidity, really knowing what your options are and what your banks are thinking, testing it beyond the sort of your relationship manager into actually really testing whether that liquidity is genuinely there, and also the time you spend with your other investors, your institutional investors, away from necessarily needing to go to market and wanting to go to market. Non-deal roadshows are absolutely something that we've seen being used to really good effect this year and last. And then, you know, flipping to the risk management piece, clearly it's heavily embedded and ingrained in the broader funding discussion. Comfort with a kind of longer term higher rate environment, you know, whether we end up at 3%, 5%, and you know, when those rate cuts kick in that Ross talked to, I think the one that's unknown, but the one thing we absolutely do know is we're not returning to a period of the last decade of rates at 0 to 2%. You know, generally, I think corporates have got a lot more comfortable with a higher, sustained, higher rate environment and the impact that has on funding costs. But what it does mean is your risk management strategy, as margins are compressed, as CapEx needs, you know, you want to support and you have a look at that. And I think ESG and transition will play an interesting part in that dynamic as well. How, therefore, you manage your key kind of hedging policies and risk around rates, around currencies, will be absolutely critical, because what we don't want is a scenario where, you know, issuers and our corporates are sort of caught short and things haven't been sort of pre-planned. So it's be nimble, be proactive, plan, and stay close to your banks, because they're absolutely you know, that the access to sort of some of the data and some of the keys to unlocking this sort of challenge.
That's great advice. Thank you, Carla. And thank you, Ross and Paul, also for joining today, and to our listeners for tuning in. Please make sure to follow us on social media to get more insights into the year ahead. And remember to click that like button so it's easier for others to find.